The June CPI data just came out. Now, this time, how you interpret the data depends on whether you are a glass half full or glass half empty kind of person. Overall, inflation did slow more than expected, which is a positive, but then food inflation still looks sticky, which is a negative. And so, in this video, I'll try to unpack this more. Let's get started. Here is where we're at. Economists expected a 3% inflation for June, but headline inflation slowed quicker than expected, coming in at 2.8%. We all know the Bank of Canada focuses more so on core inflation, and that also is improving, coming in at 3.2% versus the previous reading at 3.7%. But what's interesting is that instead of showing core inflation, excluding food and energy, on the StatCan website, like every other month, they've shifted to show another cut of CPI excluding only energy this time. The reality is that food inflation still remains high, so looking at inflation excluding energy probably makes more sense nowadays. And what we see here is there's still a big 4 in front of that CPI number, which is further from the target of 2 to 3%. Food inflation remains high, but the biggest contributor to high CPI is actually from mortgage interest. Now, shelter makes up almost 30% of the basket of CPI, and mortgage interest saw an increase of over 30% year over year for June. Now, the good thing here is that we definitely know how to bring this number down because mortgage costs are directly correlated to interest rates. And so perhaps another way to look at the CPI data would also be to look at CPI excluding mortgage interest as well. And once we do that, the CPI number looks a lot better, coming in at 2%. Let's also take a look at how CPI has been trending. So first off, in this chart, you'll see that mortgage inflation and energy inflation basically did a swap before and after rate hikes. Before rate hikes, mortgages were deflationary, and now energy is deflationary. The big difference here is that mortgages contribute to a much bigger part of the CPI basket, which is why we are seeing much bigger CPI reading these days. The other thing is that food inflation is real and it continues to remain sticky. These days, energy has been offsetting some of the food inflation, but economists do say that this probably isn't going to last because the baseline energy effects will wear out closer to the fall. And because of that, we should see CPI come up above 3% by then, unless food inflation comes back down. So in other words, we should all probably be focusing our attention on food inflation these days. Now, if we look more closely at food inflation month over month, it could be slowing, but there's really only 1 month of data right now, and so it's way too early for us to tell, and the market feels more or less the same way. Despite a better than expected CPI reading, bond yields barely fell, and so the market view hasn't changed much at this point. There is another set of data coming out next month on August 15th before the next rate meeting on September 6th. And so we do expect the markets to probably remain quiet until then. The big banks more or less have the same view as well. TD and BMO see some more positive news based on the data, but they're generally still waiting for the August data before giving more insights on where they think rates will go. On the other hand, RBC thinks rates will hold from this point on, and CIBC even sees the current rates as being an overshot at this point. On our end, we still see core inflation as being sticky, and so we're not ruling out another rate hike either. But we're definitely closer to the end of rate hikes now compared to before. We do think that either way, the Bank of Canada will continue to maintain their verbal hawkish stance and maintain the view that rates need to stay higher for longer to bring inflation down for good. Now, on the real estate side, we're actually seeing more divide here too. Most existing homeowners are feeling more pain as time goes on and more actively looking for ways to improve their holding power or even consider selling. Most buyers who need to borrow more money aren't in a hurry to buy anymore and are generally less able to buy at the same prices from spring because of the higher borrowing costs. However, a small group of investors who are cash rich are actively looking to snipe up deals. Now, in the long run, most people still agree that there is good long-term growth potential for Toronto real estate. And so this is actually the perfect environment for these cash-rich buyers to get in with deep discounts over the next few months in this bearish real estate market. Now, no matter where you stand in this real estate equation, we're here for you. We're a real estate sales brokerage focused on real estate investing in Toronto. So whether you're looking to buy, sell, or need help reviewing your existing situation, we can help. Just book a free discovery call with us by heading to this link right here. If you enjoyed this video and found it helpful, we would love your support. Give us a thumbs up and hit that subscribe button to stay up to date for more awesome content from us. Our channel is all about real estate investing in Toronto, covering everything from market trends to housing policies to interest rates and best investment strategies. We're here to make your real estate investing journey easier for you, and so our team offers services like planning, analysis, buying and selling, renovating, finding tenants, and even property management. If you want to learn more, just check us out on our website or find us on social media. Thanks so much for watching, and I'll see you in the next video. Bye.